one of the concepts that I actually find quite interesting from a psychological point of view. So it really, what I'm addressing here is the concept of making sure that you have a good interest rate over the journey of a loan, and not really, I guess, resting on the laurels that the good deal that was set up at the start continues all the way through the life of the loan for, say, a 30-year term. Just, I guess, when a broker presents a product comparison to a client at the start of a journey, the product comparison, it's impossible to simulate what that bank is going to do to interest rates over the life of the loan. So it's really important to, at a minimum, call the bank every 6 months and just make sure you've got a good rate, but then look to see what other banks are offering every few years. So the part that I'm, I guess, referring to in terms of the psychology of it, it's frustrating when we talk to people and we can say, oh, hey, we can get you a better deal. You'll save $3,500 a year in interest. And they might say something like, oh, I don't want to change direct debits, or I can't be bothered changing banks, or I've got a credit card that has points with this bank and I really don't want to, change anything. That seems a little bit frustrating from our point of view. But the thing that I really think is quite ironic is that when we're purchasing properties, we tend to become real, I guess, experts in terms of what we think the property is worth. And quite often people will stop bidding at an auction, or they won't pay any more for a property. They've decided what it's worth in their mind and they can't go beyond that. And they might say the people who bought it paid $5,000 too much for it. But the reality is, yes, the purchase price has an impact on your property cost, but the interest rate has a huge impact on the overall cost of this property. So yes, the purchase price on day one has an impact, but you have to make sure that you have a good interest rate over the life of the loan. So in this example here, if the loan required to purchase the property is $1 million and you have a good interest rate, say an average rate of 3% over the life of the loan, the total cost for this will be $1,517,000. As an example, if you're a little bit lazy, but your interest rate's not too bad, it's 50 basis points higher than that first example, the actual cost of that property is $100,000 more in the long run. Now, that is a huge amount of money in anyone's language, and it's the sort of thing that can quite easily get away from us. It's only a difference between 3 and 3.5% in this example, but you can understand that in reality, it's not that different to actually paying $100,000 more for the property at day one. So the point is, it is really, really important to make sure that the interest rate is competitive over the life of the loan and not just relying on the assumption that because it was a good deal when it was first set up, it continues to be a good deal. That's not the case in banking. It's very, very important to stay on top of the lender with phone calls, say every 6 months, to make sure you've got a good rate. And then second of all, refinance to another bank if the current lender is not coming to the party. So don't hesitate to get in touch with us if you wanted to cover off on any of these concepts.